anything remotely close to the underlying fundamental and economic reality. And I think we're going to continue to see the stock market head lower.
SDBullion.com is a high-volume physical gold, silver, and precious metal dealer. Founded in March 2012 with the goal of providing the lowest cost bullion available, SD Bullion has become one of the largest US-based precious metal dealers and is regularly recognized by Inc. magazine as one of America's fastest growing companies. SD Bullion continues to gain industry market share by being one of the premier low-cost options for physical precious metal bullion buyers and sellers. At SDBullion.com, you can order your guaranteed physical precious metal bullion products online, 24 hours a day, 7 days a week. Discreet, low-cost delivery is both fast and always fully insured. We are committed to being your trusted source for low-cost, highest quality investment-grade bullion products. Visit SDBullion.com for more information.
Hey everyone, this is Elijah Johnson with SilverDoctors.com, and back with us today is Dave Kranzler. Dave, thank you so much for joining us today.
Thanks for having me on again, Elijah. It's always a pleasure.
All right. Now, the first topic I'd like to discuss is one about the stock market, because you recently wrote an article on this, and you were saying that the stock market, the rally that we're seeing is not actually real. Can you expand on what this really is, what is really happening right now with the stock market?
Well, I mean, I can't claim to know what's really happening. I can just use my experience and look at the action and look at charts and volume and everything else that I look at and surmise that I think that the market had was getting ready to really fall off a cliff. It declined quite a bit in December. And, ever since Trump became president, he's kind of made the stock market symbolic of the success of his economic programs. To me, it's all propaganda, because the success, whether or not his economic programs are having any success, and I'm not even really sure what they are, to tell you the truth, is very highly questionable. So the stock market had become the most overvalued by many metrics of any stock market in U.S. history. And there's only a couple metrics, the PE ratio, which is based on numbers, the GAAP accounting numbers that they've made it easier to show GAAP net income over the last 30 years by adjusting and widening the judgment that is allowed when these companies are preparing their financials. So, I mean, if you use the same GAAP accounting standards that were in place in 1999, which was technically, by that standard, the most overvalued stock market in history, I'm pretty sure that the stock market at its peak a couple months ago was probably at least as overvalued as the 1999 stock market was. But anyway, the market was due for a downward correction. I mean, it's dislocated from the underlying economic and financial reality for a long time. And so that was a big part of the sell-off. I mean, politically, Trump wants to blame it on the Fed. It's not the Fed's fault. I mean, interest rates are still very low on a historical basis. I mean, they talk about normalized interest rates. Well, I don't know exactly what that means, but if you look over, say, the last 30 or 40 years, the Fed funds rate or short-term interest rates have kind of averaged 5 or 6%, and we're at, what's the Fed funds, 2.5% or something. So, it's not, everyone wants to blame the sell-off on someone and point fingers. And for me, it's simply the market was overvalued, and it's still overvalued. I don't think that, in my opinion, the stock market represents, anything remotely close to the underlying fundamental and economic reality. And I think we're going to continue to see the stock market head lower. And, the sell-off may have started today. It may not have. I don't know. We'll know in another few weeks. That's for sure.
Now, with regard to what is happening right now with the stock market, you've said that the stock market volatility we're seeing right now actually signals that the economy is unstable. Can you expand on that?
Well, to me, it's a reflection of the instability of the underlying economic and financial system. I mean, the intraday swings in the stock market right now, and that we've seen for probably the last 3 or 4 months they're mind-boggling. We've had days where there's 1,000-point swings between the high and the low in the stock market. It's rare when we have a day that goes by that the Dow doesn't swing at least a couple hundred points between the day, the high of the day and the low of the day. So to me, it reflects kind of this clash going on between people who still believe in the stock market, still believe in the U.S. economy, and the entities that are trying to unload their positions and get out of the stock market. There's a indicator that measures, I can't think of the name of it right now, I apologize, but it measures the force of buying in the first 30 minutes and then the force of the buying or selling in the last hour. And that indicator has shown, and it's considered the smart money indicator, and because the idea is that, optimists and retail buyers make emotional purchases right as the stock market opens. They want to jump in and put their money to work in the first 30 minutes. And the professionals and smart money wait to see how the day transpires. And if they don't like what they see, they use the last hour of the stock market to unload positions. Well, that indicator has been highly negative for quite some time, and it's indicative of large funds and so-called smart money getting out of the stock market. So I haven't looked at it probably in the last couple of weeks, but leading up to what they call the Christmas Eve massacre, I mean that thing was it had basically done a Wile E. Coyote fall off a cliff. So I do think that smart pools of money understand what's going on. And I think that you're going to see, these large pools of money continue to unload positions. And so the last few weeks was a perfect opportunity.
Now, then moving now to the precious metal markets, we're looking at since the beginning of 2019, precious metals are up quite a bit, especially since if we look back into December, that's when they really started to pick up. What do you think is causing this momentum in precious metals right now?
I think there's a lot of factors there. If you look at the relative levels of the mining stocks, over the last couple years, they were historically cheap by the end of 2015, and we had a huge snapback rally that lasted about 6 months. And they've been kind of trending sideways to down ever since then. And on a historical basis, they weren't as cheap as they were at the end of 2015, but they were very, very cheap relative to the price of gold and silver over a long period of time. If you look at it over a long period of time, 40, 50, 100 years. So I think, and really, you mentioned December, really gold bottomed out from its downtrend in mid-August, and gold is up 11% through today from mid-August. And if I use the GDX ETF to kind of measure mining stocks, the mining stock universe, that thing is up 17% from mid-September through today, and it had been up a little bit over 20%. Again, I find it kind of amusing that if Apple's up 20%, the financial television and the financial media is all over Apple being in a new bull market. But, we haven't heard anything about the mining stocks having rallied, 20% since mid-September. And, they're still up 17% after, a sell-off, the sell-off that we've seen since the beginning of the year. I think part of it is smart money wading into the sector in response to pulling money out of the stock market and putting it somewhere. And precious metals are traditionally a flight to safety, a wealth preservation asset. And the mining stocks are a way to make a leverage bet on the price direction of gold and silver. So I think there's that factor in there. And then also, I think there's also the factor that, the precious metals sector has a slight negative beta versus the stock market. So when the stock market is heading south, we should expect to see the precious metals sector head higher. And I think those are the two factors involved there. And in my opinion, I think we're just starting to see this trend get restarted again. And, I expect that, or I'm hoping anyway, that we're probably going to see an extended bull move in the entire sector, possibly like the one we saw that began in October, November 2008.
So you're saying this is the start of a new uptrend, and you're seeing that continuing throughout this year?
I don't want to guarantee it. I've learned over 18 years of my involvement in this sector. You can't guarantee anything in this sector, but I think there's a good probability that we could see an extended bull move similar to the one that we saw that began in late 2008. Certainly the fundamental backdrop in terms of, the economic and financial condition of the U.S. and global economy is similar to that of 2008, although I think now it's a lot worse than it was back then. And, ultimately, I use charts kind of for short-term analysis and to, sort of put things in perspective just visually for myself. But at my core, I believe that fundamentals ultimately drive value. And I think we're in a position now where the precious metal sector is very cheap relative to the underlying fundamentals.
And what is your perspective on, do you think mining stocks or the physical metal will outperform during this next rally?
It's a good question. And I was thinking about this. I've been thinking about this quite a bit over the last several weeks and months. And the short answer is, I think we're in an era now where the mining stocks will probably outperform and lead the way with the metals. But they do need the metals to move higher in order to keep moving higher. It used to be, 15, 18 years ago that you would first see the metals move higher. And actually, gold did start moving up before the mining stocks did, but the mining stocks kind of overtook the rate of return on gold pretty quickly. I think one difference between now and 18 years ago is that all these mining companies that produce have much lower production costs than they did back then. So, back then, a mining company couldn't make money at $300 gold. Well, they can't make money at $300 gold now either. But the all-in cost of production for your average gold company back then was probably, between $1,200 and $1,600 an ounce. Not the cash cost, but everything. That includes amortizing the costs that you incurred to put the mine in place, develop and construct the mine and get it going. Now, a lot of these mining companies, especially the mid-cap ones, their average cost or their all-in cost of production is somewhere between, say, $900 and $1,200. And that's just very general numbers. Some have lower, some have higher. But, versus where the current price of gold is, most of these mining companies can now make money on an all-in basis, not just a cash cost basis. So, the leverage effect of gold moving higher is even greater now than it was 15 years ago, 18 years ago. So, and again, this is just sort of me thinking theoretically. I do think that, and I would say this is probably true since the rally in 2008, or the move in 2008 started, the miners lead the market. So now, the GDX, like I said, it's been up as much as 21%. It's up 17% since mid-September now. And what I would like to see over the next 3 to 6 months is to start to see the junior miners. And the GDXJ is not really a true junior index, but it's lagged the GDX, which for me, I believe is healthy. I've talked about it in my mining stock journal in the last couple issues. It's not up as much as GDX, but at some point I'd like to see GDXJ start to outperform GDX. And then the small exploration companies, the real small cap junior exploration companies, some of them are down over the last 4 or 5 months. Some of them are flat and some of them have gone up a little bit, but they've really lagged the market. And again, I think that's positive if they start to catch up and eventually, as we've seen in past bull moves, the bull cycles, eventually the exploration juniors throw off some spectacular returns. And that's kind of what I'm looking for as we move forward, to see if all those factors sort of unfold that way. And if we do, I think we could see, an extended bull cycle here in the sector, something that lasts 2, 3, 4 years.
All right. Well, before we let you go, David, are there any last thoughts you'd like to add, and where can our viewers find you online?
Sure. I would say don't let yourself fall prey to the propaganda of a booming economy. And I believe we're in a bear market, and I don't use the infamous 20% up or down line to demarcate a bear market. To me, it looks, smells, and is behaving like a bear market. I've lived through several of them in my 30 plus years as a financial markets professional, and this thing is going to go a lot lower. And it's gravity. The gravity of true fundamentals has finally gotten a hold of stocks, and it's going to be volatile, but don't let yourself get sucked into the sharp rallies like we've seen over the past 3-4 weeks. So if just stick with your gut on this. And I can tell you stocks are going lower, and I believe the precious metal sector is going to go a lot higher. My website is investmentresearchdynamics.com, and I try to do blog posts every other day if I can find the time to put them up. And then there's links to my mining stock journal and short sellers journal that you can find on the blog as well.
All right, David, thank you so much for your time.
Thanks for having me again, Elijah.